welcome to a Learn to Trade webinar, and today we'll be looking at how to build a profitable stock portfolio. And to do this we will be using a stock screener, and Yahoo Finance has a reasonably powered stock screener that is freely available to all those who have an account at Yahoo. So if you don't have one, please go set up an account and then you can follow through on the webinar with what we are doing. So click on screeners, you'll come to the screening page where we can set up our screener. As you can see, we already have one here called travel, which we've set up, but there are a dozen or so provided out of the box by Yahoo, such as undervalued growth stocks, day gainers, aggressive small cap, portfolio anchors, conservative foreign funds. So a whole range there of screeners to choose from. So what exactly is a stock screener? Well, as its name suggests, it's a filtering mechanism. So given that there are perhaps 4,000 stocks in the UK market, attempting to drill down manually to find the ones that you want according to various criteria would be a gargantuan task to take on. And that is where a stock screener comes in, because it allows you to create filters and rules for the various criteria to screen out the stocks that you are not interested in and to home in on the stocks that you are interested in. Okay, in addition to these screens Yahoo has provided, they also provide a boilerplate approach as a starting point for various areas of the market, such as index funds. We have an index screener. For futures, we have a futures screener, where various rules or filters, as Yahoo likes to call them, are pre-populated for you, such as in this case the exchange being the Chicago Mercantile Exchange, the largest derivatives marketplace in the world, and other areas, ETFs, massively popular, exchange traded funds, mutual funds, where you'd have the basics already populated for you, such as the category the fund lives in. Example you can see here, various categories that would be relevant for mutual funds, and the issuer of the mutual fund, which company, your favourites, which is BlackRock, for example, Columbia, some of the biggest names in fund management, Henderson Global, more familiar to UK investors perhaps, Invesco, JP Morgan, and so forth. And you also get the very useful Morningstar performance ratings as well. And we'll be starting off from an equity screener, because today we want to try and build a profitable portfolio, and we have decided to go down the cyclical approach, the cyclical value portfolio. And why are we doing that? Cyclical stocks are those expected to benefit most at the beginning of the forthcoming cycle, that being the reflation trade. That's to say that the recovery in the economy post-pandemic, we're not quite at post-pandemic, but hopefully we are getting there with the rollout of the vaccines, should lead to that pent-up demand in the economy being unleashed, and the stocks one would expect to perform best in such a scenario are consumer cyclicals. So that will be the sector that we are going to focus upon. Consumer cyclicals, to make that a bit more concrete, would include industrial areas such as airlines, car manufacturers, clothing retailers, hotels, travel, restaurants, and so forth. Areas of the economy that are hypersensitive to the ups and downs of the business cycle. Okay, and we also, in addition to cyclicality, are interested in value. Again, that is partly on the basis of there being a rotation out of the mega cap growth stocks that have been leading the market higher, the tech ones in particular, and we're already starting to see some of that rotation taking place out of those highly valued stocks, some might say overvalued stocks, and into the value areas of the market. And a definition of value would be stocks and companies that are trading below their intrinsic value, are in unloved sectors, are very cash generative, are in markets that are highly defendable. They have wide moats, to borrow from Warren Buffett's analogy, and they have strong balance sheets. So I'd like to combine cyclicality with a little bit of value also. So let's begin. As you can see, the equity screener begins by offering us a region, by default the United States, but we're going to focus on the United Kingdom. We are going to select from across the market capitalization spectrum. So if we don't select any, it'll pull in all. We'll leave aside intraday price, and we will select our sector. And as we said, we wanted to home in on cyclical stocks, consumer cyclicals in particular. So let's select that as our sector. And we're not going to pick an industry because we want to actually pull in all of these industrial sectors. As I mentioned, autos as in auto manufacturers, key cyclicals, restaurants, leisure, travel services, and so forth. So we want all of those. So we won't select any, which will bring in all of them. Now let's add some more filters. As I say, we're interested in the quality of the balance sheet. So net debt to EBITDA to earnings will be of interest. Price earnings, so we can screen out the most expensive stocks, and debt to equity, EPS diluted, and valuation metrics, price to sales, price to book will be of great interest to us. Okay, let's pull those in. And create some settings. Now, net debt to EBITDA. The lower that is, the better. Less than 3 is often considered acceptable. So that's what we'll set that filter to. Price to earnings. under 30. The FTSE All Share average PE is, I think, around 24, but we'll give it a little bit of leeway, see what that pulls in. Well, it's a fair bit of leeway actually, 30, but there we are. Let's see what we get, what result we get with 30. We can always reduce it if needs be. Okay, debt to equity. Up to 150% would be considered good. We might give it some leeway and go to 200%. So let's say 0 to 200%, which means for every pound of equity, the company can have up to £2 of debt. EPS diluted, so that's earnings per share, taking into account things like stock options, a slightly more expansive definition of earnings per share, and we want the company to have some earnings, so greater than 0. Price to sales, less than 1 is considered excellent. So we'll give this setting a little bit of leeway also and set it to 0 to 2. And price to book, less than 1 is considered an excellent score. Book value being the tangible net asset value of a company, minus its intangibles and liabilities. So let's set that to between 0 and 2 also. And we've reduced the number of stocks to 17. And let's see what we pull in. And there we are. In the second part of our building a profitable stock portfolio, we'll be targeting the travel services industrial sector with a view to adding some of the best performers that we pull out from our stock screener to the portfolio that we began to set up with our previous screener, our cyclical value portfolio. So let's begin. We already have a region selected, the United States. We'll add to that the United Kingdom. We'll pull from across the market cap universe, so we won't select any of those. Sector will be as before, consumer cyclical sector. And then, unlike in our previous screener, this time we will select from an industry. And here's all the industries associated with the consumer cyclical sector. We are going for travel services. Find stocks, which there are 34. And there they are. We can narrow that down a little bit by removing the most expensive of those. So price to earnings ratio of less than 30. We could also add an element of beta. Beta being a measure of price volatility in relation to the overall market. So if the market goes up 1%, a stock with a beta of 2 will go up 2%. So that's reduced our results to 18, and here we are. It's listed by market cap, and at the top we can see 3 London Stock Exchange listed stocks. That's the .L suffix, and I think we have 4 UK stocks in total, for being Hostel World. It's good to see a fair amount of green on our table, a bit redder at the smaller cap end and mid cap end of the table. Some familiar names there, nevertheless. Travel Zoo, for example. So at the top we have TUI, the German listed package travel company. Also another package company, Jet2 PLC, which has been doing very well. I said German listed for TUI, to German and London listed, but it's a German company, hence for AG. And on the beach, it's good to see there also. There's been a little bit of profit taking today. That's because it was up 11%, I believe, yesterday. But TUI is motoring 7%. You don't see that very often. Okay, we have some anomalies which we can tidy up by removing them from our portfolio. And after we've added these to a portfolio, but TUI appears twice here in the US market, but these are over the counter listings, so we're not really interested in those. Same goes for Jet2, another over the counter listing, which is why the volume is quite small, although somewhat larger for TUI. So there we are. We could add the best performers from this list to our portfolio to bring some travel services companies into our cyclical value portfolio. Thanks very much for watching this Learn to Trade webinar on how to build a profitable stock portfolio. And please click on the link in the description, which will take you through to eToro.com, where you can begin to build your portfolio by buying some stocks for 0% commission. Now that can't be bad. Thanks again for watching, and hope to see you at the next Learn to Trade webinar.